Today, home price expectations are held up by hot air. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. In the final part of our household surveys to October 2019, we look at the results through the lens of our segmentation models. And what is clear is that there is a disconnect between future home price expectations, which are much more positive, and proposed activity. For example, there's lower demand for credit and the intention to transact is also falling. And this is at the heart of the weirdness of the property market at the moment, and it also helps to explain the low levels of listings and transactions and hence the high auction clearance rates on these loan volumes. And there is nothing in the latest results from our surveys, however, which flags significant momentum increases ahead. And we're going to start with the cross-segment trends. First, there is a significant hike in those expecting home prices to be higher in the next 12 months. It reached a low after the election and has been rising since the cash rate cuts. Portfolio investors, which are those with multiple investment properties, are the most bullish, but the expectations are there across the board. However, this does not necessarily translate into an intention to transact. First-time buyers and down traders, around 900,000 of those households, are most likely to be in the market, the former aided by the extra incentives available and the latter by the need to pull equity from existing properties. Property investors remain largely on the sidelines, and there is also a slight downward inflection in the past quarter, which may signal further slowness ahead. Another lens is demand for credit, which shows stubborn resistance other than from first-time buyers. There are around 150,000 of them actively looking, and up traders, around 550,000 who are actively looking. Refinance is tracking at levels that we've seen for some time, and this suggests that banks will have to compete hard for meagre pickings, and refinancing and first-time buyers will be the target for special deals. Those wanting to buy say that availability of finance at 40% and costs of living at 30% are the main barriers, although high home prices at 16% still registers. Interest rates and fear of unemployment are low, relatively speaking. First-time buyers are being driven by a range of factors, including the need for shelter and a place to live at 28%, greater security 14%, tax advantages at 17%, and to take advantage of the first home owner grants 12%. But that said, there are significant barriers as well, and barriers include home prices are too high at 26%, availability of finance at 39%, and cost of living at 24%. On the other hand, finding a place to buy and the prospect of rising interest rates hardly registered at all. Households seeking to refinance are being driven by reducing monthly payments at 50%, for a better rate at 22%, and extra capital withdrawals 20%. Down traders are driven by the desire to release capital for retirement at 50%, increased convenience at 30%, and illness or death of spouse at 11%. Interest in investment property has faded to 6%. Up traders are being driven by the desire for more space at 41%, job change at 16%, property investment at 22%, and lifestyle changes at 20%. And turning to investors, 45% are driven by tax benefits, better returns than deposits at 25%, and appreciating property values at 14%. On the other hand, investors face a number of barriers, including that they cannot get finance at 49% and that they have already bought at 13%. And finally, across the segments, the prime selection point is price. Although it does vary, and loyalty is not seen as a significant or rewarded factor. So standing back, it appears that property sector momentum is likely to remain patchy at best, with more action at the more expensive end of the value spectrum, and first-time buyers remaining as the primary cannon fodder with regards to new transactions. So it'll be interesting to see how the government scheme due in January changes the picture. But for now, it doesn't seem to me that there is evidence from these surveys of significant home price movements ahead across the board. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.